It's Monday the 9th, I'm FX Blue and this is CurrencyTransfer.com's market update. So weak employment headline figures masked higher wage inflation in the US on Friday. Sentiment is building against further sterling gains and the euro's just drifting. No real impetus in the single currency. So on Friday, non-farm Fridays caught everyone off guard, myself included, I'm sure you noticed. But I'm getting pretty good at getting the non-farm sweepstake very wrong. Forecast, you'll remember, was close to 200,000 new jobs created in March. The data came out in 103, the lowest number of new jobs created in 6 months. And a far cry from my 240 pledge. That's a pound I'll never see again. So the dollar index retreated from its medium-term resistance at 90.50 and actually dropped to a low of 90.07. Wage inflation grew by 2.7% in March, and this is something that the Fed will keep an eye on because, you know, as that gets closer to 3%, it may require the Fed to revisit 4 rate hikes this year. Trade war chat has been, continuing in the background. Trump's fierce rebuttal of the Chinese retaliation has increased concerns of an all-out trade war. Trump has threatened further tariffs on Chinese goods, and China has said any such move will be met with a fierce counter-strike. Now, if that's not talking up a trade war, I don't know what is. So look, after the technical move lower last week, cable eventually rallied on Friday close to 141 as the dollar weakened on non-farm data. But the bounce was not exactly convincing when you consider all the elements that are supposed to be propping up sterling: economic data, monetary policy expectation, and hopes over Brexit. The move was relatively mooted. And so then you have a look at the facts behind it. Economic data's not really been hitting home runs. Last week's services PMI data for March was down at 51.7, down from 54.5 in February. The rate hike is far from nailed on yet, and Brexit, you've still got the issues of the Irish border in the background just bubbling away quietly. Meanwhile, in the Eurozone, the euro really lacks any fresh impetus. Mario Draghi has made it perfectly clear that, and the markets are indeed now on side with this, that there will be no rate hike while inflation remains where it is, in and around 1.4, 1.5% at the moment, way under the 2% target that Draghi perceives is needed in order to consider the next move. So considering how monetary policy is such a major driver of the G7 currencies, it's quite remarkable how euro-dollar has held up and remained above the long-term support at 121.60. Charlie on the charts calls this a big, deep line in the sand, and while it remains unbroken, the euro naturally retains some positive sentiment. Euro-dollar closed on Friday at 122.91 following the US jobs report and has remained at a similar level so far this morning. Anything worthwhile, we'll keep you posted. Any questions or comments, do please pop them in the comments below. I'll see you again tomorrow.